what is the optimal amount of regulation for the bank, for Citibank, and for society, for our economy? Do you consider that?
First of all, let me say that you do need structure in capital markets and financial markets. Markets work better with structure. You know, if you didn't have contracts or you couldn't rely on law, you wouldn't be able to do what you needed to do. So the fact is that a certain amount of regulation is necessary. You got to start with that perspective. And then you got to figure out where do you go from there. I think safety and soundness of the financial system has to be paramount importance to everybody. It's on that foundation that the economy lives. And so the trade-off is really between safety and soundness of the financial system versus adequate economic growth. How do you balance the two? That's what it comes down to. And paradoxically, more regulation doesn't make the system necessarily safer, because more regulation may reduce your growth so much, limit credit creation so much, that you actually have economic problems, which increases the risk in the system. So you got to find that balance, and I think that's sort of the balance that the regulators have been trying to find. Now, there are a couple of principles I think that are really important as you try to find that balance. One is a level playing field. Nothing can impinge on the safety and soundness of financial systems as much as having an uneven playing field, because that creates enormous arbitrage opportunities. Enormous. And all of a sudden, you feel you're safe here, but the risk winds up here. So you got to have a level playing field. That's globally. It's with the shadow banking system. And once you have that, then it's a matter of where do you want to peg that level playing field? Where do you want it here? Do you want it here? Do you want it here? Where do you want it? An example is capital requirements. Where do you want the capital requirements in that system? And, you know, the answer has to be find those capital requirements that protect the safety and soundness of the system, but don't unduly inhibit growth. And that's the discussion we're trying to have.
Yesterday, Washington revealed a plan to curb proprietary trading. The Volcker rule, the bank lobby said it's way too complicated. Consumer groups say it's not tough enough. Which one is it, Vikram?
Well, I've got to go through the details and look at exactly what's in all those pages, and we're doing that right now. I do think, though, that when you go back and look at the principles of the Volcker rule, the principles are really about making sure that banks don't speculate with their capital. And we've thought that's exactly the right principle for banks, and we've been very much pro-reform along the way. The tricky part is to distinguish proprietary trading, where banks use their own capital, from market making, where banks put capital to work on behalf of clients because clients want to buy or sell things. And how and where you draw that line is very difficult. It's not philosophically difficult. We can all agree on the philosophy. It's right. But practically, how you write those rules to get to the right point is going to be difficult. Sounds to me like they may have struck the right balance on both sides. But what would concern me if I were a consumer or a customer is what would concern me is if we drew the line to a place where market making and therefore provision of liquidity in the marketplace was affected. Because if that happens, then cost of capital goes up for companies. If that happens, price of money goes up. And if all of that happens, then that's not good for the economy. So we've got to find that balance.